So the European Union and the IMF, they pledged nearly $1 trillion to bail out the region, and still the euro is down today. Is there any hope for that currency to strengthen, or are we headed toward parity with the dollar? Longtime currency strategist and current managing director at Bank of New York Mellon, Michael Woolfolk, joins us now from the NASDAQ. So, Michael, should we all be planning our European vacations? Are we headed towards parity, or do you think that there is a limit to the weakness that we may see in the euro?
Well, I think that, first off, it's always a good time to plan a trip to Europe.
Well, that's true.
Certainly with summer coming on. Parity, yeah, I think it's in the cards. Our forecast looks for parity at about 2 to 3 year time frame. Our nearer term forecast, I think that 125 is an achievable target, perhaps even within this week. The euro did get a relief rally on Monday morning, but after Moody's indicated that it may consider downgrading Greece and Portugal, it reminded us that the uncertainties that we were left with late last week are still around. We're uncertain about the political will of Greeks to actually carry through with austerity measures, political uncertainty about Germans to actually fund these rescue packages, and finally, will there be any contagion to countries outside of Greece?
Well, and our Sue Keenan was also just talking about the concern here that there are the underlying problems are not necessarily being fixed. I mean, in Greece, yes, there are these austerity measures, but in the rest of the European Union, is the perception just that more cuts need to be made and that this money is only a Band-Aid?
Well, I think that it's more fundamental than that. Certainly, that's partly true, but it goes down to the actual European project itself, the object of creating a long-term sustainable currency zone. And I think that it was left undone at the launch of the currency in January 1999. What happens once you invite a member and that member does not comply with the Growth and Stability Pact? That question is still open. Do you eject the member from the currency zone, or does that member lose sovereign right over tax and spending? The former alternative probably is not the most likely scenario. The path of least resistance is to remove the member from the Eurozone, allow them to devalue, and then to re-enter the ERM. We're probably within about 12 months of that decision being made.
So you think that is likely then to happen in 12 months, that Greece would be asked to leave and then rejoin when it gets itself in shape?
At least a 50% chance that one or more of the current members will be forced to leave the currency union temporarily. And we think that what has happened here over the weekend is this blockbuster shock and awe European financial stability plan has merely bought them time. Money can buy you time, but it doesn't buy you a solution. And the problem is there's just simply too much debt outstanding. The service of that debt will be crippling to them even after 3 years.
Well, speaking of buying, I mean, so what currencies are you buying in this environment then? Do you like the dollar, or are you looking elsewhere, to the yen, for example?
I like the dollar very much. Certainly, amidst risk-averse crisis conditions, the yen has benefited even more strongly than the U.S. dollar due to the reversal of yen carry trades. That may still be the case if we have another flurry of market risk aversion here this week. The Canadian dollar, actually, over the course of the next 4 to 8 weeks, might be a good bet as well, if the Bank of Canada decides to lead the Fed with a rate hike in June.
Well, does all of this, though, that's going on in Europe, does that put more pressure on the Fed to not raise rates? And what's that going to mean for the dollar? Just quickly here, if you would.
I think the short answer is probably yes. I think it's a secondary consideration, but the Fed obviously does not want to be raising interest rates in this type of environment just yet, with inflation clearly off the table. So I think that, yes, it's increasingly likely, given this scenario in Europe, that they hold until the end of the year.
Right. All right. Michael Woolfolk, a senior currency strategist at Bank of New York Mellon, thank you so much for joining us.
Thank you.